Washington is currently considering a radical financial penalty for countries that continue to purchase Russian energy, a tariff of up to 100%. The United States Senate has already approved this aggressive sanctions package, passing the measure with broad bipartisan support in an 86-11 vote. This authority has not yet been exercised. The legislation creates the legal power to threaten these tariffs. It does not automatically impose them. The motivation for this escalation is the ongoing war in Ukraine. While previous Western price caps and direct sanctions reduced European purchases of Russian crude, they failed to stop the flow of money into Moscow's treasury. This legislation represents a pivot in strategy. By moving past the seller, the United States is now attempting to influence the behavior of the world's largest energy consumers. When European nations reduced their Russian energy imports, Russia did not lose its customers. Instead, the global energy map was redrawn. Millions of barrels that once headed west were redirected toward Asia. China and India, in particular, saw their purchases of Russian crude surge as they absorbed the barrels Europe no longer wanted. For India, the logic is strictly economic. Because Russia is selling its oil at a steep discount, India can significantly lower its national energy bill. Those savings flow directly to refiners, transportation networks, and eventually the individual consumer. For an emerging economy, securing cheaper crude is a pragmatic step to control inflation and stabilize the currency, regardless of geopolitical leanings. Because Russia has a need to sell and India has a financial incentive to buy, Washington is introducing an artificial, overwhelming consequence to disrupt their trade relationship. This legislation relies on a secondary sanction. It uses a foreign country's access to the American market as leverage to dictate who they can and cannot trade with. If the bill becomes law, countries like India will face a stark choice: continue buying discounted Russian energy or protect their exports to the United States. A 100% tariff would effectively make their goods twice as expensive for American buyers. This strategy is not just theoretical. The executive branch has already used trade access to influence energy sourcing. In 2025, the United States applied an additional 25% tariff on Indian imports. That penalty was only modified after the White House stated that India had committed to halting its direct and indirect imports of Russian oil. The Senate bill scales that 25% warning into a potential 100% penalty. Despite the Senate's support, the legislation has stalled in the House of Representatives, facing significant resistance. The central issue is the mechanics of how tariffs are paid. When a tariff is enacted, the foreign government does not pay the U.S. Treasury. American importers pay the border tax. If the tariff is 100%, the cost of importing immediately doubles. Businesses then face three choices: absorb the loss, find new suppliers, or pass the cost to the consumer. The House is hesitant because a weapon designed to drain Moscow's resources could simultaneously act as a tax hike on American households, potentially fueling domestic inflation. If the threat succeeds and major nations stop buying Russian oil, it will create a massive supply void in the global market. Those nations would be forced to buy millions of replacement barrels from other producers, like Saudi Arabia or the US, driving up global demand and increasing oil prices for everyone. The risk expands significantly if these tariffs are applied to China. China is both a major consumer of Russian energy and a primary source of goods for the American economy. Applying this legislation to Beijing could transform a targeted energy sanction into a broad trade conflict, putting electronics, machinery, and global supply chains at risk. Nations facing extreme financial pressure do not always comply. Some retaliate or establish new trade routes to bypass the pressure. Overusing the American market as a weapon could push emerging economies to build alternative financial networks that function entirely outside the U.S. system. The Senate has constructed the architecture for this weapon. The House now decides whether to use it. International trade has become a primary tool of national security. Whether the House passes or kills this bill, it signals that the next global economic disruption could begin with a single barrel of Russian oil.